In this video we learn about pricing of material issued. There are 4 types of pricing of material issued. And they are as follows: 1 HIFO, 2 NIFO, 3 LIFO, and 4 FIFO. Before we start, please like, share and subscribe Arjun Productions. And also don't forget to hit the bell icon.
Highest in first out, HIFO, method. By this method, quantities of materials are issued at the highest price of materials on hand. When the quantity having the highest price is exhausted, the next highest price is used in valuing issue. When this method is used in, production becomes highest, so that the profit is reduced. During a period of increasing price level, the method is equivalent to LIFO method, and in a period of decreasing price level, the method is identical with FIFO method. HIFO method is of theoretical interest only as it has not received wide acceptance. Highest in, first out, HIFO, is an inventory distribution and accounting method in which the inventory with the highest cost of purchase is the first to be used or taken out of stock. This will impact the company's books such that for any given period of time, the inventory expense will be the highest possible for the cost of goods sold, COGS. And the ending inventory will be the lowest possible. HIFO usage is rare to non-existent and is not recognized by GAAP. Accounting for inventories is an important decision that a firm must make, and the way inventories are accounted for will impact financial statements and figures. Companies would likely choose to use the highest in, first out, HIFO, inventory method if they wanted to decrease their taxable income for a period of time. Because the inventory that is recorded as used up is always the most expensive inventory the company has, regardless of when the inventory was purchased. The company will always be recording the maximum cost of goods sold. The company will always be recording the maximum cost of goods sold. Contrast this with other inventory recognition methods such as last in, first out, LIFO, in which the most recently purchased inventory is recorded as used first, or first in, first out, FIFO, in which the oldest inventory is recorded as used first. LIFO and FIFO are common and standard inventory accounting methods, but it is LIFO that is part of generally accepted accounting principles, GAAP. Meanwhile, HIFO is not often used and is furthermore not recognized by GAAP as standard practice. Under the NIFO method, the price of material which is to be next received. And now we learn about next in first out, NIFO, method. Under the NIFO method, the price of material which is to be next received is used in valuing issued materials. It is based on the assumption that the price of the next consignment is known before it is received. If by the time the materials are received, the production is completed, the production cost of materials shows the value of most current purchases. This method is almost similar to LIFO method but is more forward-looking, and under this method, cost of production reflects the current prices of materials. And next is last in, first out, LIFO. LIFO stands for last in, first out, meaning that the most recently produced items are recorded as sold first. Since the 1970s, some U.S. companies shifted towards the use of LIFO, which reduces their income taxes in times of inflation, but since International Financial Reporting Standards, IFRS, banned LIFO, more companies returned to FIFO. LIFO is used only in the United States, which is governed by the Generally Accepted Accounting Principles, GAAP. Section 472 of the Internal Revenue Code directs how LIFO may be used. The difference between the cost of an inventory calculated under the FIFO and LIFO methods is called the LIFO reserve. In the example above, it is $750. This reserve is essentially the amount by which an entity's taxable income has been deferred by using the LIFO method too. In most sets of accounting standards, such as the International Financial Reporting Standards, FIFO, or LIFO, valuation principles are in fine subordinated to the higher principle of lower of cost or market valuation. In the United States, publicly traded entities which use LIFO for taxation purposes must also use LIFO for financial reporting purposes 3, but such companies are also likely to report a LIFO reserve to their shareholders. A number of tax reform proposals have argued for the repeal of LIFO tax provision. The Save LIFO Coalition argues in favor of the retention of LIFO. Last in, first out, LIFO, is a method used to account for inventory that records the most recently produced items as sold first. Under LIFO, the cost of the most recent products purchased, or produced, are the first to be expensed as cost of goods sold, COGS. Which means the lower cost of older products will be reported as inventory. Two alternative methods of inventory costing include first in, first out, FIFO, where the oldest inventory items are recorded as sold first, and the average cost method, which takes the weighted average of all units available for sale during the accounting period and then uses that average cost to determine COGS and ending inventory. Now we understanding last in, first out, LIFO. Last in, first out, LIFO, is only used in the United States where all three inventory costing methods can be used under Generally Accepted Accounting Principles, GAAP. The International Financial Reporting Standards, IFRS, forbids the use of the LIFO method. Companies that use LIFO inventory valuations are typically those with relatively large inventories, such as retailers or auto dealerships, that can take advantage of lower taxes, when prices are rising, and higher cash flows. Many U.S. companies prefer to use FIFO though, because if a firm uses a LIFO valuation when it files taxes, it must also use LIFO when it reports financial results to shareholders, which lowers net income and, ultimately, earnings per share. Last in, first out, LIFO, inflation and net income. When there is zero inflation, all three inventory costing methods produce the same result. But if inflation is high, the choice of accounting method can dramatically affect valuation ratios. FIFO, LIFO, and average cost have a different impact. FIFO provides a better indication of the value of ending inventory on the balance sheet, but it also increases net income because inventory that might be several years old is used to value COGS. Increasing net income sounds good, but it can increase the taxes that a company must pay. LIFO is not a good indicator of ending inventory value because it may understate the value of inventory. LIFO results in lower net income and taxes because COGS is higher. However, there are fewer inventory write-downs under LIFO during inflation. Average cost produces results that fall somewhere between FIFO and LIFO. If prices are decreasing, then the complete opposite of the above is true. At last we learn about first in, first out. FIFO stands for first in, first out, meaning that the oldest inventory items are recorded as sold first but do not necessarily mean that the exact oldest physical object has been tracked and sold. In other words, the cost associated with the inventory that was purchased first is the cost expensed first. With FIFO, the cost of inventory reported on the balance sheet represents the cost of the inventory most recently purchased. FIFO most closely mimics the flow of inventory, as businesses are far more likely to sell the oldest inventory first. FIFO will have a higher ending inventory value and lower cost of goods sold. FIFO stands for first in. FIFO most closely mimics the flow of inventory, as businesses are far more likely to sell the oldest inventory first. FIFO will have a higher ending inventory value and lower cost of goods sold, COGS, compared to LIFO in a period of rising prices. Therefore, under these circumstances, FIFO would produce a higher gross profit and, similarly, a higher income tax expense. First in, first out, commonly known as FIFO, is an asset management and valuation method in which assets produced or acquired first are sold, used, or disposed of first. For tax purposes, FIFO assumes that assets with the oldest costs are included in the income statement's cost of goods sold, COGS. The remaining inventory assets are matched to the assets that are most recently purchased or produced. The FIFO method is used for cost flow assumption purposes. In manufacturing, as items progress to later development stages and as finished inventory items are sold, the associated costs with that product must be recognized as an expense. Under FIFO, it is assumed that the cost of inventory purchased first will be recognized first. The dollar value of total inventory decreases in this process because inventory has been removed from the company's ownership. The costs associated with the inventory may be calculated in several ways, one being the FIFO method. Example of FIFO. Inventory is assigned costs as items are prepared for sale. This may occur through the purchase of the inventory or production costs, through the purchase of materials, and utilization of labor. These assigned costs are based on the order in which the product was used, and for FIFO, it is based on what arrived first. For example, if 100 items were purchased for $10 and 100 more items were purchased next for $15, FIFO would assign the cost of the first item resold of $10. After 100 items were sold, the new cost of the item would become $15, regardless of any additional inventory purchases made. The FIFO method follows the logic that to avoid obsolescence, a company would sell the oldest inventory items first and maintain the newest items in inventory. Although the actual inventory valuation method used does not need to follow the actual flow of inventory through a company. An entity must be able to support why it selected the use of a particular inventory valuation method. Special considerations. Typical economic situations involve inflationary markets and rising prices. In this situation, if FIFO assigns the oldest costs to cost of goods sold, these oldest costs will theoretically be priced lower than the most recent inventory purchased at current inflated prices. This lower expense results in higher net income. Also, because the newest inventory was purchased at generally higher prices, the ending inventory balance is inflated. FIFO vs. Other valuation methods. LIFO. The inventory valuation method opposite to FIFO is LIFO, where the last item purchased or acquired is the first item out. In inflationary economies, this results in deflated net income costs and lower ending balances in inventory when compared to FIFO. Point 1. Average cost inventory. The average cost inventory method assigns the same cost to each item. The average cost method is calculated by dividing the cost of goods in inventory by the total number of items available for sale. This results in net income and ending inventory balances between FIFO and LIFO. Now we will learn with an example. In question we have some information. In opening stock we have 400 units at 11 Rs. On February 3rd we issued 300 units goods. On February 10th we purchased 200 units goods at 13. On February 10th we purchased 300 units goods at 10. On February 18th we issued 400 units goods. On February 21st we purchased 100 units goods at 09. On February 28th we issued 200 units goods. So now we will solve with this question with all methods. First we solved with HIFO method. In this method we issue higher price goods first. On February 18th we issued 200 unit good at 13 Rs. First because it higher. Also on February 25th we issued 200 unit good at 10 Rs first. Now solved with LIFO method. In this method we issue last comes goods first. On February 18th we issued 300 unit good at 10 Rs. First because it last comes. Also on February 25th we issued 200 unit good at 9 Rs first. Now solved with FIFO method. In this method we issue last comes goods first. Now solved with FIFO method. In this method we issue last comes goods first. On February 18th we issued 100 unit good at 12 Rs first because it comes first. Also on February 25th we issued 100 unit good at 9 Rs first. Also on February 25th we issued 100 unit good at 10 Rs.